Welcome to your custom deep dive. Our mission today is, well, pretty focused. Cutting through the noise on the latest big financial products hitting the U.S. market, we're talking about a new wave of crypto ETFs.
Yeah, exchange-traded funds. And critically, these go way beyond just Bitcoin.
Exactly. So we're zeroing in on, what, three specific tokens?
That's right. We're looking closely at Solana, Litecoin, and Hedera. They seem to be leading this new charge. And maybe most importantly, we need to break down a key feature, particularly for Solana, staking.
Staking, right.
Yeah.
Big topic. But maybe just quickly, let's set the stage for anyone listening. What exactly is a crypto ETF?
Good starting point. Think of it as a wrapper, really. It's a fund. It trades on a regular stock exchange like the NYSE or NASDAQ.
Okay.
And it lets investors, big institutions, or even you through your regular brokerage account, get exposure to something like Bitcoin or Solana.
But without the hassle.
Exactly. Without actually buying the coins, messing with digital wallets, private keys, all that technical stuff. It's about easier access and, crucially, fitting into the existing financial plumbing.
Makes sense. Accessing compliance.
Yeah.
And the news now is that we're seeing these non-Bitcoin ones lining up.
Yeah, it looks like a whole wave is potentially set to debut very soon, maybe even next Tuesday. That's based on the official listing notices popping up from the exchanges.
Okay, Tuesday. Let's unpack that. This isn't just chatter then. These are specific funds moving forward.
Correct. We have pretty solid info, largely thanks to folks like Bloomberg analyst Eric Balchunas, who track these filings religiously.
So who are the players? What tokens are actually involved in these specific notices?
The ones that have shown up recently are Bitwise's Solana ETF, that's SOL.
Right, SOL.
And then funds from a company called Canary for Litecoin LTC and Hedera, which is HBAR.
Okay, so Solana, Litecoin, Hedera, that's quite a mix. Why those three, do you think?
Well, that's where it gets interesting, right? It maybe tells us something about how the SEC is thinking. Solana is, the big proof-of-stake player, lots of programmability, seen as future tech. Litecoin, though, that's almost the opposite in some ways. It's much older, simpler, uses proof of work like Bitcoin. It's often called the silver to Bitcoin's gold.
So its inclusion maybe signals comfort with established, sort of simpler chains?
Could be. It suggests they're okay with established chains regardless of how they reach consensus, maybe because Litecoin's regulatory status has been less controversial over the years.
And Hedera. HBAR often seems to fly under the radar a bit compared to the others.
It does. Hedera's angle is more enterprise-focused, uses a different tech called Hashgraph. Its inclusion might mean the regulators are getting comfortable with DLTs aimed at business solutions too, not just open cryptocurrencies. So yeah, it's a diverse group.
Very diverse. Now, you can't really talk about crypto funds without mentioning Grayscale.
Yeah.
Are they involved here?
They are, but in a slightly different way. Balchunas also mentioned that Grayscale's existing Solana trust.
The trust?
Right. It's expected to convert into a proper ETF maybe the day after that first batch launches.
Okay, explain that for us. Converting an existing trust versus launching a brand new ETF, why is that distinction important?
Oh, it's quite important. A conversion often implies, let's say, a smoother path. The assets are already managed by Grayscale. The structure is known to regulators.
So it's less of a leap?
Kind of. It's more like the SEC giving a thumbs up to change the wrapper from that less liquid, often premium or discount-heavy trust format into a fully fledged, easily traded ETF. It suggests they aren't finding new fundamental issues with the underlying asset, in this case, Solana.
Right, just allowing it to trade more freely. So that brings up the backstory. How did we even get here? I mean, just a couple of years back, a spot crypto ETF in the U.S. seemed like a pipe dream.
Exactly. The groundwork was really laid earlier this year with the first U.S. spot Bitcoin ETFs. That was the breakthrough.
Let's nail that down. The date the Bitcoin ETFs got the green light, that was critical, wasn't it?
Absolutely pivotal. The SEC approved those first spot Bitcoin ETFs on January 10th, 2024. That wasn't just about Bitcoin. It was the SEC basically saying, okay, this ETF structure can work for holding actual crypto assets safely.
And that opened the door for the big traditional finance players, the ones who live and die by regulatory approval.
Precisely. Suddenly you had BlackRock, Fidelity, Bitwise again, Grayscale converting its big Bitcoin trust, WisdomTree, VanEck. All these massive firms could jump in because the fundamental structure was approved.
So that Bitcoin approval basically created the template, the regulatory path for these other assets like Solana and Litecoin, assuming they aren't deemed securities themselves.
You got it. It set the precedent.
Now, what about hurdles? We heard talk about a potential federal government shutdown starting October 1st. Is that slowing things down?
That's a fair question and a relevant wrinkle. Yes, a shutdown officially began, and it can stall many government processes. However, but sources are confirming the SEC is still operating, even if it's with a skeleton crew, maybe. And crucially, these ETF listings often proceed based on notices being deemed effective after a certain period, a process that apparently can continue even with limited staff.
Especially if the groundwork's already done.
Exactly. Especially since the main precedent, Bitcoin, is set, and the key technical question for Solana, staking, also got recent clarity. So these specific filings seem to be able to move forward despite the broader slowdown.
Okay, so the gears might be grinding slower elsewhere, but the path for these specific ETFs was clear enough. The January decision is really paying dividends now.
That sums it up perfectly. The big structural hurdle was cleared back then.
All right, let's pivot now to the really innovative part, especially for the Solana ETFs, both the potential Bitwise one and the Grayscale conversion. Staking. This feels like a big step beyond just holding an asset.
It absolutely is. It gets into the actual mechanics of how some blockchains work, specifically proof of stake or POS chains like Solana.
Right. Explain POS and staking simply.
Okay, so unlike Bitcoin, which uses massive computing, power proof of work, proof of staked chains, rely on users or validators locking up their own coins, that's the stake.
Locking them up. Why?
They lock them up as collateral, essentially, to vouch for transactions and secure the network. It's their skin in the game.
And they get something for doing that, for taking that risk.
Yes. In return for providing that security service, they earn rewards. Usually these rewards are paid out in more of the same token, like earning more SOL for staking SOL.
So it's like earning yield directly from the network itself.
Pretty much. And that changes the investment case, right? It's not just hoping the price goes up,
Yeah.
it's potentially generating an ongoing return. That looks a lot more like familiar concepts like dividends to traditional finance folks.
But historically, that yield thing was a regulatory minefield, wasn't it? It sounded
Yeah.
too much like interest from a security.
Exactly. That was the big blocker. So being able to include staking rewards within an ETF wrapper, that hinges entirely on a really important clarification from the SEC.
When did that happen?
That came back in September. The SEC issued a statement clarifying that basically certain ways of doing staking, or perhaps how staking services are offered.
Don't automatically make it a securities offering.
Correct. That was the green light fund managers needed. It allowed them to design products that capture that native yield without immediately falling into the potentially unregistered securities trap.
Okay, but let's pause there. We're talking yield, staking. Sounds good. But what are the risks involved that maybe a traditional ETF investor isn't used to?
Ah, good point. The elephant in the room? Staking isn't free money. There's risk. If the validator you delegate your stake to messes up, goes offline, tries to cheat the network,
What happened?
there can be slashing penalties. That means a portion of the staked crypto, including potentially the investors' funds within the ETF, could be destroyed as a punishment.
Ouch. Okay, that's definitely different.
And there's often lockup periods, too. The staked assets might not be instantly liquid. You might have to wait days to unstake them. So if the fund needed to sell assets quickly, that could be a problem.
So the ETF manager handles the staking complexity, but those underlying risks slashing lockups, they still exist within the fund's operations.
Precisely. The investor is shielded from the how, but not entirely from the what if.
Right. So once the SEC gave that September clarity, how fast did the fund industry react?
Almost immediately. Actually, even before that September statement, back in July, a firm called Ari Asprey launched a Solana staking ETF on the Cboe BZX exchange. They were kind of first movers, testing the waters.
Old move.
Yeah. And then after the September clarification, you saw the bigger players make their moves. We know Grayscale added staking to its Solana trust pretty quickly after that statement.
And Bitwise.
And Bitwise's proposed Solana ETF, the one expected maybe next week, explicitly includes staking features right from the start. It seems like for any future proof of stake ETF, staking is now almost table stakes, pardon the pun.
Nice one. Okay, so this feels like more than just a few new products. What does this trend, this integration of staking mean for, well, for crypto's relationship with traditional finance?
Well, I think so what here is massive. We're clearly shifting gears.
Right.
We went from Bitcoin ETFs, which are basically just price exposure.
Buy and hold.
Right. To now, products like these Solana ETFs that integrate the native utility of the blockchain, that ability to earn yield through staking, but packaged neatly inside that regulated, familiar ETF structure. It's Wall Street figuring out how to plug into DeFi mechanics.
And the crypto native industry sees this coming too. I was reading comments from Thomas Sohm. He's the COO at Jito, which is a big liquid staking protocol on Solana.
Ah, Jito, yeah.
Yeah.
Liquid staking adds another layer entirely. What did Dom say?
He basically said these ETF approvals are just the beginning. He's already looking way past launch day.
Makes sense for someone in his position. What's he seeing next?
Get this. He mentioned Jito is already working with, quote, tier one investment banks on products related to these ETFs, specifically things like accumulation strategies using staked Solana ETF options.
Wow, okay, let's break that down. Staked Solana ETF options. What does that likely mean? It means the big institutions aren't just planning to buy and hold the ETF. They want to use the yield generated by the staking as a foundation for more complex strategies.
Like derivatives.
Exactly. Maybe writing options contracts where the value is linked to the expected staking yield, or using the yield-generating ETF itself as supercharged collateral to borrow against, knowing there's that built-in return stream.
So it's not just digital gold anymore. It's becoming a yield-bearing financial instrument, fully integrated, with layers of traditional financial products being built on top almost immediately.
That's the trajectory, absolutely. We're seeing the rapid financialization of proof-of-stake utility packaged for Wall Street. It really validates assets like Solana, in their eyes, not just as speculative tech, but as productive assets.
Okay, so let's wrap this up for the learner. What are the key takeaways? We've got this new wave, Solana, Litecoin, Hedera ETFs hitting the U.S. market.
Right, showing the regulators are getting comfortable beyond just Bitcoin across different types of chains. Bitwise and Canary are launching new ones. Grayscale is converting its existing trust.
And the precedent was set by those Bitcoin ETFs back in January 2024.
Correct. But the real game changer here, the detail to really remember, is the staking. The successful integration of earning yield inside the ETF.
Driven by that SEC clarification in September.
Exactly. That shifts crypto ETFs from just being about price exposure to potentially being about yield generation too, all within that regulated fund structure. That's likely the template for future proof-of-stake ETFs.
It's pretty incredible watching this integration happen so fast.
It really is. And it leaves you with a thought, doesn't it? If staking, a core DeFi mechanism, is now inside ETFs, what does that mean for the regulatory path for other tokens with unique, maybe even more complex on-chain functions? And just how fast will Wall Street try to package up and financialize every other aspect of DeFi? Definitely something to keep an eye on.